Want to own a slice of one of the best businesses on the planet? Like the idea of collecting a market-beating dividend that's been growing at 20% per year? Looking for a good deal on a high-quality stock after it's fallen by nearly 25%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading home improvement retailer catering to the American dream of home ownership. Shelter is a basic need, but who only wants shelter? Nobody. What people want is a home, a refuge from the crazy world out there where they can find peace and raise a family. And with more people than ever starting to actually work from home, this company has been going gangbusters. Revenue is going gangbusters. Profit is going gangbusters. And the dividend is going gangbusters. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Home Depot Inc., which appear to be trading at a significant discount today. Home Depot Inc., stock ticker HD, is the world's largest home improvement retailer. Founded in 1978, the company is now a $330 billion by market cap retail monster that employs 500,000 people. They operate over 2,300 stores across the US, Canada, and Mexico. More than 90% of net sales occur in the US. The typical store averages approximately 105,000 square feet and offers more than 35,000 products. Their e-commerce channel offers 1 million products. Is it 1922 or 2022? A global pandemic and sad, unnecessary war in Europe has us feeling a bit like it's the former. Some say history repeats itself. I'd argue that it at least rhymes. There is a rhythm to everyday life, and this rhythm in people's thought patterns and actions makes it easier to invest in sustainable trends with a high amount of long-term visibility in terms of repeat business. One such example is homeownership and home improvement. Shelter is a basic need in life. This has been true since the dawn of time, and it'll remain true until the end of time. And most people would rather own than rent said shelter. Going beyond just the basic need is the desire to make a comfortable home out of their shelter, and this involves customization and improvement, not to mention ongoing maintenance. Then you up the ante when you factor in that more and more people are working from home, which only reinforces customization and increased maintenance from additional wear and tear. This plays right into the hands of Home Depot, which should translate to increasing profit and dividends for years to come. Home Depot has already increased its dividend for 13 consecutive years. In fact, they just increased the dividend only days ago, marking that 13th straight year. The 10-year dividend growth rate of 20.3% is highly impressive, and you're even getting a solid 2.4% yield to go along with that high growth rate. This yield, by the way, is 30 basis points higher than its 5-year average. With a payout ratio of 48.9%, the dividend is secure and positioned to continue growing aggressively. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. We're on the bubble here with that yield, but the high dividend growth rate more than makes up for it. Great dividend metrics across the board. Looking at business growth, Home Depot increased its revenue from $74.8 billion in fiscal year 2012 to $151.2 billion in fiscal year 2021. That's a compound annual growth rate of 8.1%. I usually look for a mid-single digit top-line growth rate from a mature company, and make no mistake about it, Home Depot is mature. However, Home Depot blew away my expectations here. Growing revenue at 8% plus annually when you're coming off of a $75 billion base is remarkable. Meantime, earnings per share expanded from $3 to $15.53 over this period, which is a compound annual growth rate of 20%. Outstanding. We can now see where that huge dividend growth came from. Huge EPS growth powered it. Breaking down the difference between revenue and EPS growth, a combination of margin expansion and aggressive buybacks caused a lot of excess bottom line growth. For perspective on the latter point, the outstanding share count is down by 30% over the last decade. Looking forward, CFRA believes that Home Depot will compound its earnings per share at an annual rate of 4% over the next 3 years. Lining that 4% forecast up against a 20% historical result seems strange. What gives? Well, I think a lot of it comes down to the likelihood of a severe pull forward in sales. Home Depot has benefited from certain pandemic-related events. For instance, people have been fleeing dense cities and more commonly working from home for an extended period of time. Now, let me be clear here. Homeownership isn't a trend. It's a lifelong goal for many people. And the work from home situation seems to have legs. That said, it is difficult to expect results over the last, say, 12 to 24 months to be perpetual. Once certain home improvements have been completed, they're done. There are only so many kitchens to remodel, decks to build, and home offices to fashion. If we take CFRA's forecast as the base case, I still think Home Depot offers a compelling setup for long-term dividend growth investors. That's because a slight expansion in the low payout ratio could support high single-digit dividend growth, even in the face of low single-digit earnings per share growth. And this is only a near-term situation. If we take a step back and look at Home Depot's general trajectory before the pandemic hit, they were doubling EPS roughly every 5 years. I see no reason why they couldn't return to something like that once things normalize, which would set up dividend growth to be at least in the high single-digit range over the long run. Pairing that with a 2.4% starting yield is enticing. Moving over to the balance sheet, the company's financial position is great. There is no long-term debt to equity ratio here. A substantial amount of treasury stock due to aggressive buybacks has led to negative shareholders' equity. However, the interest coverage ratio of over 17 tells the more accurate story. Simply put, Home Depot has no issues whatsoever with debt. Profitability is robust, especially for a retailer. Over the last 5 years, the firm has averaged annual net margin of 9.7%. ROE is not applicable here because of that negative common equity. This is a fantastic business from top to bottom. Fundamentally speaking, Home Depot is running one of the world's greatest enterprises, and the company does benefit from durable competitive advantages, including economies of scale, pricing power, brand value, product specialization, and a differentiated workforce that guides consumer purchases. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Retailing is a particularly competitive industry which pressures margins. The company is exposed to the broader economy as spending on homes and home improvement is partially reliant on economic confidence, strength, and expansion. Any shifts in consumer spending habits can impact the business. An acute concern is the possible pent-up demand for services, which could reduce spending on products. Most of the company's stores are located in the United States, limiting growth potential and geographic diversification. A hot U.S. real estate market could correct at any time, which would likely negatively impact the demand for general spending on homes. These risks should be carefully thought over, but I still think the quality of the business easily outweighs all of them. And after a nearly 25% drop from its recent peak, the stock's attractive valuation makes this idea even more compelling. The price-earnings ratio is 21.1. This is well below its own 5-year average of 23.3. For a company that's been growing at 20% per year, this is not a high earnings multiple, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the high end of the scale, but there's no reason why it doesn't befit Home Depot. The company has demonstrated its ability to grow its EPS and dividend at a much higher rate than this over a long period of time. While a pull forward in sales could cause a near-term growth headwind, the company's structure is such that the long-term tailwind should gust much stronger. And with the payout ratio being as moderate as it is, the company can easily sustain high single-digit dividend growth until such time that the business gets back to a more normalized growth rate. I don't see this hurdle as difficult for Home Depot to clear. The dividend discount model analysis gives me a fair value of $410.40. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Home Depot as a 2-star stock with a fair value estimate of $244. CFRA rates Home Depot as a 4-star buy with a 12-month target price of $395. I came out pretty close to where CFRA is at. Morningstar's number looks way too low to me, but they do note that they'll be increasing their fair value estimate after incorporating Q4 results. Averaging the three numbers out gives us a final valuation of $349.80, which would indicate the stock is possibly 7% undervalued. Here's the bottom line, guys. Home Depot Inc. is a high-quality retailer showing tremendous strength across every facet of the business. Catering to the American dream of homeownership is very profitable, and it's only become more profitable with the work-from-home trend showing legs. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, 13 consecutive years of dividend increases, and the potential that shares are 7% undervalued, this is a fantastic name for long-term dividend growth investors to consider adding to their stock depots. And now for a special news announcement. The price of oil is blowing past $100 a barrel now, but Chevron Corporation, stock ticker CVX, is sticking to their guns on prioritizing shareholder returns over capital expenditures and additional production. This is just what I said they'd do. Indeed, I noted the appeal of this new discipline paradigm in a recent video that we put out on Chevron and why Warren Buffett was aggressively buying shares in the oil supermajor. The stock is up nearly 15% since that video came out, but with the new discipline, focus on shareholder returns, and high price of oil, Chevron might be just getting warmed up. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.